This is Ethan, CFA Charterholder and investment professional, and today I'm going to go through the quick hit potential impacts of the Trump red wave on a wide range of investment related areas, including inflation, interest rates, the national debt, the dollar, crypto, housing, China, Europe, and a couple of key industry winners and losers. One line disclaimer: this is not a pro or anti Trump video. It's a pro making money regardless of who's president video. And in my opinion, smart investors don't mix their politics with their portfolio. Let's start with inflation since it's broad and impacts everyone. The obvious impact is that it's likely to go higher. But the questions are: why will it go higher? How much higher will it go? And how long will it last? To answer why, I think that's a simple one. There are three reasons I'd point to. Trump has threatened to put either 10 or 20% tariffs on every import that comes into the US and up to 60% on imports from China. I'll talk more about how realistic these are throughout the video, but conceptually, here's how tariffs work. The US puts a tariff on an imported good. The company selling that good has to pay the tariff, which is a tax, to the US government. But the company isn't just going to start selling their products at a loss or let that eat into their profit. They're just going to raise their prices to make up for it. So prices go up, aka inflation. US consumers are really the ones who pay for the tariffs. We'll come back to this in a moment. The second way inflation could be driven higher is by pro growth policies like increased government spending from tax cuts and lower regulations. And the third way is through curbs on immigration. These two work together because pro growth policies boost demand, and curbing immigration could cause labor shortages, which obviously would reduce labor supply. How high inflation will go is pretty dependent on how high tariffs go. Those are likely to go on pretty soon after Trump takes office. But the question is, does he go straight to a 60% tariff on China and a 10 or 20% blanket tariff on everyone else? If he did, that would lead to a massive spike in inflation, probably at least 5%, but it's really hard to say. Some goods would be much more expensive, as in maybe 60% more expensive, but that might have a negative impact on consumer spending and growth, which would then bring inflation back down after that the coming year or two, maybe even to lower than it is now. However, I think that scenario is not that likely. It's all speculation at this point, but here are a few reasons why tariffs are not likely to be as high as many people fear. One, Trump might raise tariffs more gradually to use them as a negotiating tool to extract concessions from other countries. Two, he might appoint people to key positions like Treasury Secretary that would caution him against going too extreme and freaking out the market. Three, or he might go too extreme and freak out the market, then pull back when he realizes that the market is tanking and his base is pissed about rising prices. Or, number four, he might find that a blanket tariff is legally challenging in a lot of areas, like where we already have free trade agreements in place, so it may not quite be to the full extent of what everyone fears. There'll also be some combination of these, of course. But I'll just remind you that the market had the same fears last time he was elected, and the tariffs did not end up nearly as high or widespread as initially feared. I don't necessarily expect that to repeat exactly because his team is much more organized this time and ready to hit the ground running when he takes office, but I think maximum tariffs right off the bat are pretty unlikely. We all know Trump likes to start big as a negotiating tactic. As an investor, it doesn't feel good because you have to consider what will happen if he does what he says, but I still consider that to be an unlikely scenario, which is why I'm predicting a modest increase in inflation in 2025. If these have been scaring you, all I would say is keep calm and carry on. It's usually not as bad as feared. As far as how long inflation will last, I think that regardless of what happens in 2025, it'll likely fall in 2026 and be somewhere in the range of normal, like maybe 2 or 2.5% by 2027. Tariffs are inflationary, but they're also only a one-time hit. At a minimum, they would not raise prices any more the second year than the year that they were put on. More likely, some of them will be reduced or removed as Trump negotiates deals with countries to get other things he wants in exchange for removing the tariffs. That could lead to falling inflation in 2026 and 2027. On the other hand, pro-growth policies and anti-immigration policies will take longer to implement, but will also have longer-lasting impacts. So I wouldn't expect inflation to go right back down to 2% in 2026. The one exception would be if the impact from tariffs is so negative that it gets people to really curb their spending. Again, I don't think that's very likely. I think Trump will try to pair up his pro-growth policies with his higher tariffs and exempt some key areas so consumers don't feel the hit quite as much. Who ends up getting key positions like the U.S. Trade Representative and Treasury Secretary will also definitely be important, though. The key impact on markets from higher inflation will be higher interest rates. You can see from this chart that the 3-year rates in green, 5-year rates in orange, and 10-year rates in blue have all risen since early October as people realized that either candidate would have likely been inflationary, and they spiked on the day of the election. You can see on the bottom left that I told people in our Discord on August 7th that I thought interest rate expectations were unrealistic, medium and long term rates were likely to rise, and core bond funds were likely to lose money. Nailed it. And I think the move we've seen over the last month and a half could continue a little longer. I'm not predicting that the Fed will raise rates. I just don't think that they'll cut them very fast, which is consistent with Fed Chair Jerome Powell's comments last week. And if they don't cut rates very fast, intermediate term interest rates like 3 and 5 years will probably rise. Rising inflation expectations would also be likely to lift longer term rates. Since shorter term interest rates still pay you more and have lower risk of losing money if rates rise, that's still my preference for bond investments right now. So will all this extra government spending lead to a national debt crisis? No, I doubt it. Here's some food for thought. Charts like this one are based on the Congressional Budget Office's projections. They have to assume that current policies will stay in place forever, which of course they won't. And with projections 30 years out into the future, the projections are highly sensitive to tiny changes in growth estimates, interest rate estimates, and so forth and so on. No matter how good or bad the next administration is for the national debt, they'll only be in power for 4 years, and whoever comes next will do something different. Even in 2054, based on these estimates, the debt to GDP ratio will still be lower than it is in Japan today, and they're not having a financial crisis. The US dollar is also the reserve currency, which is a unique advantage only to the US. And there's really no other viable alternative that's liquid and freely tradable like the dollar. So while the debt could become an issue one day far in the future, it's pretty unlikely to happen in the next 4 years. As far as the housing market goes, I think it could be negatively impacted. Does that mean a market crash? No. That's fear-mongering BS and you should ignore it. But incrementally, if rates are higher, that could mean homes are less affordable and supply remains limited for longer. As long as rates are high, people aren't going to want to move out of their homes. I'll just use myself as an example. If I wanted to sell my house and buy another one with the same value, my monthly payment would be about twice as much as I'm paying now. And I only bought this home about 3 years ago. So I'm not going anywhere, and I think a lot of people are in the same boat. Falling immigration and rising tariffs could also increase the cost of maintenance, remodeling, and home building, which would also, all else equal, make homes less affordable. Sorry, I wish I had better news on that one, but maybe as a consolation prize, at least it's not as bad as the situation in China. On October 2nd, we put out a video calling China the investment opportunity of the decade. And if you're questioning our sanity, not only for doing that, but also for bringing it up again today, I'd encourage you to watch it. But for this purpose here, basically what I said was that the recent changes in China made me long-term confident in the recovery, but that I was going to be selling on the current rally. So far, it's playing out exactly as I expected. The stimulus that investors were excited about proved to be way underwhelming, and now the election is causing a further sell-off. Someone in our Discord asked me the other day if I thought it was time to add again, and I said no, not yet. Here's what I'm thinking about China. They have lots of problems with their economy. We've done multiple videos explaining them if you're interested. President Xi finally acknowledged that they exist and decided to do something about them. That's a big long-term positive. But he didn't want to go too far, too fast with the stimulus for 2 reasons. One, it could encourage the same type of unhealthy behaviors that got them into this mess in the first place. And 2, he needed to save some money or some dry powder, so to speak, to stimulate the economy further and counteract the tariffs that he knew might be coming if Trump got elected. So, could there be a scenario where tariffs end up being much smaller than the 60% people fear at first, which then leads China to make a deal and then the market rallies and I would miss it? Yes, that's possible. But I think it's more likely that President Xi will wait until he hears the negative announcements from the US so he has time to assess the damage. Through that point, I think the market is likely to stay weak and volatile. And then after that, I think that there's a reasonable chance he could end up stimulating the economy more. He could also strike a deal that would ease the burden of the tariffs like he did last time. So basically, I think it could get worse before it gets better. Now, a few more interesting nuggets on China. I heard from some, let's just say, high up sources within the Chinese government that China doesn't even know what Trump wants to accomplish with the tariffs. And I heard from some people close to Trump that he doesn't really know either. So it's likely to get messy, and there's still a pretty wide range of outcomes, but none of them are really good for China in the short term. As far as retaliation, China could target agricultural purchases from the US, critical mineral imports, or US companies with a lot of exposure to China like Tesla, Boeing, Apple, or basically anyone with a CEO that President Xi thinks Trump might listen to. But it's also possible they could hold back on retaliating to see if they can get a deal. TBD. Things for Europe aren't looking great either. Trump has always been annoyed that in some categories of goods, Europe has higher tariffs. Of course, there are also categories of goods where the US has higher tariffs, but I don't think that's going to do much to save Europe here. I've actually heard that he wants to hit Europe even more than he wants to hit China. I'm not sure I believe that, but I did hear it from a credible source, so take it for what it's worth. He also doesn't like that some European countries don't meet their NATO spending target of 2% of GDP on defense, and he doesn't think that the US should be funding the war in Ukraine. He doesn't like that the US has a trade deficit with Europe either. He has a lot of issues with them. I'm not here to debate the merits of any of those, just to assess the potential market impacts. Ultimately, I think the tariffs on Europe could be aimed to extract concessions, and some potential ones that come to mind would be the EU agreeing to step up defense spending, implement tougher China policies, or buy more stuff from the US. I also think the EU will want to negotiate before retaliating. They still see the US as a key ally and want to preserve that relationship as much as they can. As far as Trump's claim to end the war in Ukraine on day one, I highly doubt that. There's basically no resolution on the table right now that would make all parties happy, and on top of that, why would he give Putin what he wants without getting something in return from him? If the war did end, I think that would probably be great for Europe. We go from having a war to not having a war, and that makes everyone feel better. I also think that would hurt defense companies and push natural gas prices down, but like I said, I don't see that as likely to happen right away. All right, let's go quick hit style the rest of the way. The dollar will probably strengthen since higher rates and higher growth lead to more flows into US dollar based assets, which strengthens the dollar. Crypto has been rallying since Trump got elected because the industry thinks he'll get rid of the anti crypto head of the SEC and put favorable regulations in place. That may be the case, but some of the crazier speculation, like funding the national debt with Bitcoin, come on, be real. You could also make the fundamental argument that Bitcoin and Ethereum aren't even regulated by the SEC because they're treated as commodities, but ultimately the only thing that really matters for crypto is sentiment. And if the sentiment is positive, then it's good for crypto. Banks are another potential winner, since a strong economy and reduced regulations could both help them. Regional banks are the biggest beneficiaries of easier regulations, so they've rallied a lot, but they'll also be hurt by persistently higher interest rates. So after the rally, I personally wouldn't chase it from here. Small cap companies are another beneficiary of reduced regulation and a strong economy. Reduced regulations can cut costs, which are sometimes more of a burden for smaller companies. Tariffs that make it less appealing to import things could drive business for some smaller domestic companies. And tariffs just also generally do not hurt smaller companies as much as big companies because big companies are generally more global and have more diverse supply chains. That said, small cap companies do have higher borrowing costs, so if interest rates stay higher for longer, that could sap some of their momentum. Another potential winner is the defense industry for probably obvious reasons. Not only do we have many ongoing geopolitical tensions around the world, but Trump might pressure Europe and Japan to spend more on defense. The one caveat is that if the war in Ukraine does end at some point, that could be a negative for defense stocks. The oil and gas industry is a little mixed. The initial sentiment was positive drill, baby, drill, right? Falling regulations and more favorable energy policy should also be helpful. So should strong demand with a strong economy. But if they drill more, then prices go down, right? And if the war in Ukraine ends at some point, Russian natural gas could come back into Europe, pushing natural gas prices down. That would obviously also not be good for natural gas producers. And finally, one industry that might be in for a tougher time is healthcare. This is still TBD, but there's been a lot of fear running through the pharmaceutical industry since RFK was nominated as the HHS secretary. He's seen as an anti vax conspiracy theorist in some circles. I'm not sure I buy that he's that radical. And outside of vaccines, I think his bigger issue might actually be with the food industry than the pharma industry, but we'll see. Before I go, I'll leave you with two key messages. One, there are a lot of uncertainties about how things will play out, and things will get a lot clearer when we know who gets appointed to key positions. Two, there are many factors that are way more important for long-term stock market returns than who the president is. This is my job, so I like doing this stuff, but for most people, it's probably best to keep your politics and your portfolio separate. And on that note, If you feel the need to make a politically charged comment on this video, go for it. It'll help the algorithm, but neither Kyle nor I are going to respond. If you have a question or comment that is not entirely driven by your pure love or hatred for Donald Trump, then we'd love that and look forward to hearing from you. If you found this video helpful, hit the like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you'd like to connect with my partner Kyle and I directly, you can do so by joining our Discord through the link in the description below. We'll look forward to seeing you in the next video.